Hello. Hi friends. This is your Mr. D. Dharmendra Madhu Sadarangani, MFD ARN 10533, mobile number 887-987-8870. Let's unveil the new NFO by Bandhan Mutual Fund. As you must be aware of, Bandhan Mutual Fund is the previous name was IDFC Mutual Fund, has been renamed as Bandhan Mutual Fund. IDFC mutual funds, everybody were aware of its the performance, the team, and the returns generated by IDFC mutual funds. One of the most profitable AMCs in return generating. It has been renamed recently, known as Bandhan Mutual Fund in collaboration with the Bandhan Group, taken over by Bandhan Group. So it is Bandhan Mutual Fund. It is an old AMC with a new branding. Same work management, same team with a new face. And they have come up with an NFO, Bandhan Financial Services Fund. So let's unlock the vault of potential opportunities in this investing in this fund. The NFO will close on 24th of July 2023. It's ongoing since 10th of July 2023. So you can invest it anytime. Online easy links are available on all my Facebook, Twitter, social sites. You can just click if it is suitable as per your risk appetite and goals. You can click it and within few minutes you can invest it, or forms are also available. NFO forms are available which can be downloaded and submitted anywhere in India at Bandhan Mutual Fund offices, AMC offices, or CAMS, RTA, Registrator and Transfer Agents, wherever you feel suitable, or personalized services too available. You can reach out to me. Offline, online services are available, or even we can fill up the form for you and can provide you the services. You have to just print, sign, attach the check and the PAN card Xerox copies, the relevant documents, and submit wherever you wish, like anywhere in India. You can reach out to me at my email ID vibes41@gmail.com. Let's look at why financial services fund and why now, and why Bandhan Financial Services Fund we should invest. These are the major queries. Why? First, let's look step by step. Why financial services? Now, financial services sector has a solid track record of wealth creation in the long run. You can check the historical trends of 1,000 invested in March 2005 till March 2000 till March 2023. The Nifty 500 TRI index has grown at a CAGR, compounded annual growth rate of 13.7%. That is 10 times over the longer term. Nifty 500 TRI is the Nifty index. 1000 invested during March 2005 in Nifty index has grown to 10,752, 10x, 10 times. Whereas the Nifty Financial Services TRI index has grown at a CAGR of 17.3%, that is almost 18 times. 1000 invested in March 2005 have grown up to 18,859. So that is a strong potential growth, a wealth creator in the long run, beating the Nifty diversified index funds Nifty 500 with an huge margin, where 10x as compared to 18x. Financial services offer a wide spectrum of investment opportunities across segments. Like the financial service sector is diversified across 5 broad sectors with 19 subsectors. The 5 broad sectors are insurance, capital market, fintech, finance, and bank. And in insurance, it is again subsector. There are general insurance and life insurance. In capital market, there are asset management companies, which we call it as the mutual funds, depositories, NSD, CSDL, clearing houses, exchange and data platforms, financial product distributors, web aggregators, rating agencies, Morningstar, CRISIL, stock broking and allied companies associated with the capital markets. And there are then fintech companies, financial technology companies. And in finance, is a financial institution, holding companies, housing finance companies, investment companies, microfinance institutes, non-banking finance companies, that is known as NBFC, and other financial services. And in banks, it is again categorized subsectors as public sector bank, private sector bank, and other banks. Other banks are like small finance banks, payments, that comes under the banks. Financial services continue to be the dominant part of the services economy, large contributor to the services GDP. If you see the track record as per the graph, the service sector contributes more than half of the country's GDP. In two services sectors as percentage of overall GDP, it was in 2001, it was something between 48 to 50%, or almost 49%. Within, it was between and it had grown up till 57% in 2021 and 22. And the contribution, financial services as a percentage, this is an overall services sector, financial service sector growth, overall growth. And in terms of percentages, you can see there was a drawdown in 2013 and 14 due to the banking crisis, NPAs. 17-18 also, there was a huge part of reconciliations, and so in times of NPAs, it has been a drawdown, but it has a tremendous growth, and it has been moving around 37%, and it is moving around over 37% and still moving up. The services sector contributes more than half of the country's GDP. Financial sector contributes roughly 1/3 of the services sector. Among the services, there are many services sectors. Among that, one third the ratio goes to the financial services sectors. Their contribution is one third. Financial inclusion has been a key enabler in the recent years because of the recent developments and the government schemes like Jandhan account. Government covers 90% of the population over 15 years age group. Then there has been mobiles, over 40 crore smartphone added in India in past 6 years. India offers one of the lowest mobile data prices and has the highest number of internet users, and bank aggregators even leading from the US. India is rating number one in the number of uses, in the number of transactions, and by all the government schemes and improvements, almost 95% of the population are now under biometric digital identity card, Aadhaar card, that have added to the had made the financial services easier and convenient for even a common person. You can check the data points 2022 versus 2015. In 2015, Jandhan account was the GEM 10 is in crores. It was around 11 crores, close to 11 crores, has risen because of the efforts. It has risen to 48 crores in 2022. Aadhaar, it was 20 crores, has risen to 133 crores. Mobile data subscriber, the internet subscriber in 2050 were 28 crores, as compared to today is 78 crores, or can be higher. The high level of digital acceptance has reflected a huge change in payment ecosystem. The changes recently after the COVID, the dynamic changes have happened in the revolutionary changes in the Indian banking systems. People have started accepting the digital modes of payment and has been widely used. Digitally enabled population, along with the growing use of digital models like UPI, MPS of payments, are strong enablers for credit penetration, providing a strong runaway for credit growth. For a banks or financial institutions, it is if the lending growth have a strong runaway for the credit growth, the bank survives, the institution survives, the exchanges, payment exchanges. Here you can see the UPI mode, the ATM mode is on the top level, which I think almost everybody must be using. But the rise, this is the orange, you can see that is IMPS. That has also rise significantly since 2017 till 2000. It is increasing. And the middle, the white, the gray portion you see, IMPS, the UPI proportion has gone up from 6% to 61%. This gray portion is check clearing. Now check acceptance is reducing as the mode of check payment is still a strong and a major holds, but it is reducing since 2022, 21, 22. It has been reducing, and the share has been increased by IMPS immediate. You just open your app or WhatsApp, transfer your payment to your friend, to anybody. You are buying a grocery, just you did a IMPS or UPI transaction, and it's just through. So the digitalization and the IMPS share has grown up from 6% to 65% and is still moving further. What the sector offers? This fund offers a diversified opportunities to invest, not just banks. When we talk of financial services, we just understand as a layman banks. This is a thematic fund, sector oriented, is just not banks. I am trying to simplify in a very simple way for an ordinary layman or anybody can understand, because mutual funds are for everyone, for each and every individuals. Financial services sector universe offers diverse opportunities to invest. Large profit pool share, diversified sector, wider set of companies. Financial services remain the single highest contributor to the profit pool of the market. Largest contributor, you have to understand, it is the largest contributor to the pool of profit pool of the market. Financials in S&P 500 share, weight of the financials in BSE 500 is 30%. The overall S&P BSE 500 index, if you check in that the capitalization, the overall weight of the financials is 30%, close to one third, and financial share in profit pool of BSE 500 is almost close to it. It had been lowered. The red line you can see, it had been lowered during 2018 as the banks have been shut down. During the lockdown period 18-19, but the tremendous rise in the digital sector, and when during the online, people started, after some time they started revolving themselves, accepting the new modes and changing their payment and transaction behavior methods at ease. Emergence of new investment opportunities in the last decade across segments. The sector offers investment opportunities not just restricted to traditional banks but also many emerging segments like small finance, AMC, clearinghouse, exchange and data platforms, housing finance companies, microfinance companies, HFCs, MFIs, insurance, fintech, etc. Number of listed companies across segment under the financial sectors have grown up significantly. In 2010, the public sector banks were 10 as compared to 2022. There are 22 banks. Private sector banks were 10 as compared to 22. In 22 is 20. Overall, other small banks have also grown up to 5% in 2022. Asset management companies have also grown up 5 listed companies. Depository clearing houses in 2022 has grown up from 0 to 3. Exchange data platforms listed companies 3. Financial product distributors in 2022 have grown up to 2. Rating agencies, it has doubled from 2010 from 1 to 2. Stock broking and allied companies from 19 it has moved to 22. Financial institutes in 2022 there are 7 listed. under the financial services sector. These are the companies listed under the financial services sectors. There may be many other companies, but can be under the primary company, can be something else or listed under some other sectors. Holding companies 11, housing finance company from 2010 5 it had grown to, to almost 11 companies. Investment companies from 28 to 30. Microfinance institutions have grown up to 4. Non-banking financial companies, NBFCs, from 34 it has reached to 41. Other financial services 13, as in 2010, and in 2020 it has reached to 14. Financial technologies, fintech institutions have doubled from 2010, from 2 to 4. General insurance, there are 24 general insurance companies in 2022 listed. Life insurance companies, from 2 it has reached to 2006 in 2022. So you can see the tremendous growth potentials and still growing up. They have risen because there is an acceptability and there's a huge tremendous growth and profitability. That's why they merges, the new companies rises. And this I'm talking about the organized sector. In the unorganized sector, there will, I don't know how many multiple times it must be having, but we deal only with a registered companies and registered MP registered AMCs. So we talk about only about the organized sectors. India offers a high multiple year credit growth opportunities. Credit to GDP ratio as percentage. Credit per capita. You can see in developed market Switzerland, it's 279% of credit to GDP ratio, and credit to per capita in dollars is 2,49,432 dollars. In Canada is 220%, and credit per capita in dollars is 1,17,656. In Australia, it's 181%. Credit to GDP ratio, it's over 100 times in developed markets. That is a sign of developed markets. And per credit to per capita income is 1,09,387 dollars. In United Kingdom, is the credit to GDP ratio is 150%, and credit per capita in dollars is 63,839, and in United States it's 155% credit to GDP. It's more lending, credit to GDP, and credit per capita is 113,366. Almost all Americans must be using credits, credit cards, or any kind of credit facilities, lending, borrowing. Japan, 187% credit to GDP ratio, and credit per capita income is 59,498. When we look at the emerging markets, let's look at Indonesia. It's 42% to GDP ratio, and its credit to per capita income is $1,820. Mexico is 40%, and credit to GDP ratio is 4,187. South Africa is 67% credit to GDP ratio, and the credit per capita, the usage, the penetration per capita is 4,276. Saudi Arabia 74% credit to GDP ratio, and per capita credit to per capita is $20,335. Thailand 178% with a credit per capita is 11,983. South Korea 222% credit to GDP ratio, and credit per capita income is 70,721, and China is 220% of the GDP growth with an per capita income of $26,721, and in India it's just an 88%. India is just booming up, and its credit growth is just moving up, and its credit per capita income is $1,976. India's credit to GDP at 88 looks lower than other countries, but credit per capita is even lower than the and has a huge room for growth. Growth in payment gateways or growth for financial sectors to boom has a strong potential growth. For any companies, it should have a healthy growth, have a strong balance sheet with an excess liquidity, and then has a sound credit rating. And for a country, the first sign of country's growth is when the financial sectors move up. When there's a growth in the financial sectors, that is a sign the lending, the transactions, the markets are moving, the market opportunity rises, there's a tremendous growth. Of course, other sectors too contribute to the growth. That is the infrastructures and other things, the governance, the government policies. But this is a clear indication of the growth by looking at this sector, financial sector. Whether it's booming or whether it's weak, it shows for temporary it has gone to a setback phase. The market has gone to a setback phase. It is just a clear indicator. The first sign you see in these sectors, financial sectors, Tezi Mandi. GDP growth revival can lead to an healthy credit growth going forward. Credit to GDP multiplier, it was strong in 2006, but nominal to GDP ratio was lower, and at this time in 2023 estimated the credit to GDP growth multiplying effects can be above between 1 to 1.5%, or you can call it nominal GDP growth can be estimated to 13.9%, and credit to GDP multiplier going to 16%. Credit growth has been on a downtrend due to the multiplicity of reasons, including weaker banks' balance sheet, That that is the history now. The NPA, non-performing assets, for last few years from since 17, 18, that had led to a weaker balance sheets. Now the provisions have already been made and the credits have been written off. Banks have been consolidated. Governments have taken, RBI and other government measures have taken to straighten up. So strong push on public capex, like government expenditure in infrastructure or other reforms like credit growth, export policies, other policies, and with some visibility, green shots in private investments offering lucrative investment opportunities, China plus strategy in India, that will lead to the boom of the Indian economy and will rise the credit growth, and banks and financial services sectors will flourish. With recovery in GDP growth, credit growth is gathering pace. It's moving up, it's still gathering the pace. Indian banks are in the best of health with regard to capital adequacy. Indian banks are well capitalized. In Taiwan, it was around 9%. Capitalized above the regulatory requirements. It is strict norms of the RBI, and it has been already, the NPA has been written off. Now in this coming years, with the non-performing assets has been written off, and in some parts we are receiving it, so it is an additional profit for the banks. Capitalized above the regulatory requirements of 11.5% total CAGR, and 9% as and 9% in tier 1 in phases. The regulatory requirements have been 11.5%, which is well regulated. They have to keep an adequate reserves, SLR, repo rate, margins. All the performs makes an healthy banking. Banking credit has grown at its healthiest pace. Banking credit distribution in 2009, it was 26 trillion. It has reached to January 22 to 118 trillion. And where it the credit, the loans or any kind of banking credit distribution goes to 16 trillion in agriculture and allied activities, 34 trillion in industry, micro and small and finance and large scale industries, financing loans, SMEs, other retailers. Then 32 trillion goes in the service sector, service oriented businesses, service sectors, any kind of service sectors, and commercial vehicles, all kinds of services related to the services, and personal loan regards to 36 trillion. So the total overall in January 22, it has reached to 118, banking credit distribution 118 trillion. It has grown by more than 4.5 times since 2009 at an CAGR, compounding annual growth rate, it multiplying effects, annualized growth rate at 13%. This sector. Non-banking finance companies and housing finance companies have exhibited a higher growth in these shares. The major growth we have seen in NBFCs and housing finance companies. NBFC non-banking finance trends, the lenders, Patpeti or some other non-banking finance companies. It has moved from financial year 2013, 8,520 billion to financial year 22, 29,087 billion. These are the RBI data. You can check at the RBI websites. And housing finance company growth AUM. The growth has gone from 3,902 billion to 13,281 billion as loans and advances given by housing finance company, and previously 29,087 billion as loan and advances by the non-banking financial trends. Secular growth in AUM and PAT, profit after tax, at non-banking finances at the CAGR of 15%. With the pickup in demand in housing market, it is likely to gather pace of going ahead for housing finance companies at a CAGR of 15%. With housing finance companies to grow at a CAGR of 15% as estimated, and exponential growth witnesses in capital market segment with increased retail participation, robust capital market activities in crores, daily cash average turnover in crores is close to 15 lakh crores in financial year 2023 as compared to less than almost 18 something, close to 18 something, 18,000 crores in 2000 financial year 2009. It has grown to almost close to 15 lakh crores, and futures and option average daily wages turnover in crores have gone up. The credit lending, the FNOs, has gone up close to above 15, can be close to 16, 17. The average turnover since financial year 2009 FNOs has futures and options trading, the turnover has been 341 times, and the cash turnover, daily cash turnover, has multiplied 4 times since financial year 2009 in recently till in financial year 2023. And demat accounts since financial year 11, it has reached to 11.4 crores. The demat account have increased, have multiplied 5.5 times. You can understand the amount of trading, the financial transactions, the future and options, the commodity tradings, the currency tradings, all kinds of tradings, investments. The demat account have raised to, has multiplied 5.5 times since 2011, and it is still rising till the end of the financial year 2023. It was 11.4 crores demat accounts. only when someone has an healthy balance or a lending or something. And even the demat accounts, you can trade with an margins and other services provided. So it has become simplified for many of them. Mutual funds are witnessing a robust SIP flows and a secular asset growth. Robust SIP flows in crores. In April 2023, it has reached to 13,728 crores. SIP contribution since April 2016 till April 2023, it has reached to 4.4x. It has multiplied almost 4.4 times, and AUM in crores in mutual fund is 4 lakh 1,052,715 crores as per data of March 2023, and still growing up. With all your investors, all your contributions, all your investments, with your support, so you should give a round of applause to yourself, everybody around. AUM has grown over 3 times during the period from March 16 to March 23. Insurance sector is still under penetrated and has a long way to grow. Insurance penetration snapshot globally. If you check United States, the insurance penetration is 11.7%, Brazil is 3.9%, South Africa is 12.2%, United Kingdom is 11.1%, France is 9.5%, Germany is 6.5%, China is 3.9%, South Korea has a good shares of insurance. The insurance sectors has been good, 10.9%, Taiwan 14.8% has a good penetration, Indonesia 1.6%, South Africa 12.2%. The global average is 6.8%, and India's penetration is just 4.2%. And recently, government is emphasizing on all the insurances sectors, the pension plans. The government is taking keen and providing all the regulatory changes so that everybody can benefit it. RBI is taking in measures to it. So this insurance sector has a long way to grow in India. Still, an average Indian is still undercovered. You may say I have an insurance policy, but whether you are adequately covered, that's the question. So in India, the insurance sector has a long way to go and still has a long penetration to it. Emergence and evolutions to fintech players offer the dynamic opportunities like payment gateways, emerges as a faster cross-border payment solutions. Now, if you want to do payment anywhere abroad globally, it's just with a few clicks you can do it. The easier the emergency to the fintech players. Lending, digitalization of asset backing lending. You can buy foreign assets, foreign transactions you can do, digitalize more of lending. Well-tech, convergence of robo-advisory services with personal finance kiosks and other unified robo-services makes it easier. They add to the wealth of that institutions, growth of the institutions, fintech infrastructure, launch of retail wholesale, central digital currencies, RBI rupee, SDFC, digital currency apps have already there, and many banks and RBI rupees is already there. Digital currency is always is there in the circulation, making it easy to retailers and wholesalers. Neo banking, expansion of the millennium MSME focused neobanks. Neobanks are the online payment gateways, online bankings. Like if you do a payment to either IRTC or you are doing some payments, you will find the Reserve Pay, or you are doing some uh, Google Grocery or any grocery shop, online digital payments you do. You will see the payment is done through some aggregator. They are neo bankings like Razor Pay or some other names it comes, and they facilitate the services done. So there are many emergencies of the neo bankings online. They are only digital bankings, providing a digitalized services. You can call it an banking aggregators that combines the supplier ends of the supplier and the buyer. Then there's a insurtech, rise of digital platforms of insurance distribution. The insurance has also been digitalized in many sectors. So with an ease of insurance digitalized, enablers, these are the fintech companies. Fintech growth are capitalizing on growth, strong demographic, increasing digital adaptation, maturing, maturing data ecosystem, and product expansions. Now, why now the NFO has come out, the Bandhan Financial Services Fund? Financial services valuation are at a very relatively attractive levels. If you check the price to earning of Nifty Bank Financial Services, the average long-term averages of the financial services price to earnings is at 22.2 over the years since April 2006 till April 2016, the average. And if you see the Nifty price to earnings, Nifty 50 price to earnings, that is a red line. It is at almost 21.5, and Nifty financial services price to earning is even lower than that. It is at 18.1. It is at a below average point. So you can call it most of the sectors, the price to earning is very cheaper, so it is a right time to invest. That's why it's a right time to invest in the NFO who selects, because when we go for checking and selecting the individual stocks, not all of them but most of are at a cheaper valuations. We can do ourselves individual picking up the stocks, but when we get a bouquet at a very reasonable price, and in individual stock the investment is also used in mutual funds with a small investment, with a minimum investment, we get a professional management research teams and manages the fund, and we get the best of it. The valuations of the Nifty financial services are at 18.1, is below the long-term averages. Performance over the long term, Nifty financial services performance, if you compare to Nifty 500 TRI, that is the Nifty index. If you check the 3 years trailing returns, Nifty 500 had given, if you had invested in Nifty 500, it had given a 27.6%, and Nifty Financial Services has given in the last 3 years trailing returns 27.8%. And in 5 years time, Nifty 500 had given a 12.3%. Nifty Financial Services, the trading returns 12.5%. And in 10 years, you, you can see the Nifty 500 had given, TRI has given the 14.2%, and Nifty Financial Services TRI has given a 15.1% trailing returns. And if you see the standard deviation, Nifty 500 in 3 years is 15.3, and Nifty Financial Services is 21% of a standard deviation, and in 5 years period, Nifty 500 standard deviation is 18.6, whereas Nifty Financial Services standard deviation is 25.1%, and Nifty 500 standard deviation over the 16 years is 16.6, and Nifty Financial Services TRI, the benchmark, has 10 years standard deviation is 22.7%. That indicates the sector has outperformed the broader market Nifty 500 across the time frames. And what is the risk taken? Returns on per unit of risk. In Nifty 500, the risk returns on the risk per unit taken. There is always a risk and return matrix. Whenever we invest, there is certain proportionate of risk involved in it, in anything we invest, and the returns what we get. So the returns as per the unit of risk return is a risk return matrix. In Nifty 500 over the 3 years, it's the risk return as per the risk taken is 1.8%. In Nifty Financial Services is 1.32, but in the trailing 5-year returns, if you check Nifty 500, you can check 0.66% return per unit of risk, as well as Nifty 500 is 50. And in 10 years, returns per unit of risk, Nifty 500 is 0.85, and returns in financial sectors have given 0.60 returns per unit of risk. The risk matrix is 0.66. These are the sources of the Bloomberg. You can check all the data agencies, data aggregators. This may offer a relative attractive point for investors to make an entry in the financial sector fund. And the best way is the NFO, which starts newly. Key drivers of returns in the market outperform 11 out of the last 17 years. If you check from the year 2007 till 2022, Nifty 500 TRI percentages and Nifty Financial Services TRI percentages, and they outperformed in 2007. It has outperformed by 22.4%. In 2009, because of the Lehman crisis, it has been lowered. It has been a minus 2.1%. Again in 2010, again they gave up. It has outperformed by 15.8%, and so on. So if you check the 36 phase of the outperformance and underperformance cumulative, 36% during the period, 25% during the period, it has outperformed 36% from 2017 to 2022, and it has underperformed 25% during the period and cumulative 37% during the period. And estimated in 2023, YTD, it has outperforming with a good margin of 73%. So upcycle of 23% opportunities lies ahead, because last 2021 years it has been a lower performance, and the reasons everybody knows. Now it's time, it has already to outperform with the booming economy and other governance and RBI measures and the growth potentials, India's growth story. Why this particular fund, Bandhan Financial Services Fund? It has a three dimensional approach for stock selection and portfolio construction. The three-dimensional approach are: the portfolio construction criteria will be on the earning trajectories, strong and profitable growth trajectories, identifying inflection points where trajectories can change, management quality, again the strong corporate governance, minority shareholders alignment, strong track record and execution, business growth, competitive positions, how competitive they are in the position, capital efficiency as reflected in ROA and ROE, return on earnings versus peers, ability to withstand a business economic cycle. So basically, it is a flexi cap approach with a growth oriented portfolio actively managed with bottom up stock picking. Instead of going to the sectors, they go to the individual stocks, then rising up. That's called the bottom up stock selection. This, now we have talked all the positive aspects, but while investing, you should know even some of the drawdowns, some of the risks associated with the sectors. With always returns, there are always some kind of, some degrees, some risks is always attached to it. So there can be a risk of macro risks, like actions of global central bank recessions, war on political upheaval, or major economies in India may adversely impact the banking financial service industry sector. Like COVID, it was a sudden, which has no control. So these are certain risks. Interest rate risk. This sector is highly sensitive to interest rates, and thus any adverse movement in benchmark interest rates may impact the profitability of the companies, because they are in the lending business. Some and non-banking financial companies, some can affect. These are credit risks. Most BFSI companies run the risk of financial loss resulting from the borrower's failures to repay and loan, which may turn result cash flow interruptions and high provisions. Default that we have seen earlier in 2018 and 19, even the measures have been taken, strict implementation, and we have learned from the past, but it doesn't guarantee that in future it may not happen. And from time to time, some part or other part, it does happen in some companies. It does happen default in low repayments. Then we have to turning down the cash flow interruptions, and then we have to make the high provisions for the bad debts. Regulatory risks. The banking financial service industry is a highly regulated sector, is very strictly controlled. Thus, changes in the norms by the regulators can significantly impact the cost structure and in turn profitabilities of the companies. Tech disruptions, new technologies, rapidly evolving technologies have reduced the entry barriers for new companies, leading to heightening the competition in the BSFI space. but sometimes the competition is advantageous also. But these are some risks associated we should know before investing. Now, key takeaways. It has a long investing. It will give the long-term growth opportunities in the sector. Sector has a solid track record and is diversified. It is a well diversified sector with 5 broad sectors and 19 subsectors. So when we talk of financial sector, we should not think of only the banks or some banks. It is a very broad sector, 5 broad sectors with 19 subsectors, and in that the stocks low credit penetration compared to peer economies with a strong banking position, growing digitalization and opportunity that may pick up. Growth and valuation parameters look favorable. Nifty Financial Service Index valuation at the reasonable levels. Sector has been a key driver of returns in the market, outperformed the market over a 10-year and 5-year CAGR peer-to-peer basis, beaten the Nifty 500 11 out of last 17 years. So, Bandhan Financial Services Fund offers an opportunity to invest in sectors across banks, NBFC, non-banking financial capitals, capital market, insurance, and fintechs with a flexi cap approach, and growth-oriented approach. Who is suitable? Who is this fund suitable for? Who is suitable for? Suitable for allocation for a non-core portfolio for alpha generation. One portfolio is an ideal portfolio, and there is another room for non-core portfolios. Core portfolios are like ESS, children funds. Uh, there are some many other funds considered as our core portfolio, and there is always a slight room, a slight percentage where we can take a leverages for alpha generations. It is suitable for them. Investor looking to participate in diversified sector with rapid expansion and potential growth opportunities, who want to participate in this, who want to miss the rally, miss the bus of financial sectors in the upcoming years. Being a sectorial fund investor need to have a relatively high risk appetite because it is a sector fund. So the risk is attached to that sector. As a sector, it has a higher risk appetite for a potential of higher return, and it does provide an probability of generating a higher returns in the long run. And the fund managers are Sumit Agrawal, who has almost 18 years of experience in equity market, Manish Gudwani, having over 25 years of experience. They all experienced fund managers, and the fund details are they invest. It is an open-ended scheme. You can buy and exit anytime, subject to the exit loads applicables. Investment objectives: the scheme seeks to generate a long-term capital appreciation by investing predominantly in equity and equity-related instruments of companies engaged in financial services. There is no assurance or guarantee that the objective of the scheme will be realized. This is a disclaimer as per the guidance, SEBI regulatory guidance. Mutual funds are subject to market risk. Invest as per your risk appetite, always aligned to your goal. The disclaimer: minimum application amount is of rupees just 1000 lump sum, or an SIP you can also do with a multiple of rupees 1 thereafter. Plans are You can have a growth option. You can have an IDCW options like uh, reinvestment and payout. IDCW reinvestment or payout option, but I will advise to go for a growth option because we need to create a wealth in next few years. We invest for the capital appreciations, and if we do an IDCW, yeah, for some persons, if it is required to have an cash flows, fine, regular intervals, but then it reduces your appreciation because the what growth we have already eaten up, and is small bits and fractions we don't understand, but in growth the same thing, it gives a compounding effect and it multiplies at a faster space over the years. Exit load if redeem or switch within the 1 year from the date of allotment, as like other equity funds, 1% is applicable of the NAV. If redeem or switched out after the 1 year from the date of allotment, exit load is nil. And Mr. Sunil Agarwal will and Manish Gunwani equity portion, Harshal Joshi for debt portion, of few debt portion like for cash reserves or has to be kept some small portion for liquidity pressures, redemption pressures, and Nishita Shah for overseas investment portion, a small portion like if some arises. Benchmark is Nifty Financial Services TRI, and the riskometer always in any of the equity fund you pick it up, it will be at the higher end. So, and being a sector fund, it is a very high because it is a sector oriented fund is a fund, and this is your mutual fund MFD, Mr. D. Dharmendra Madhu Sadarangani. You can reach out to me at 887-987-8870, ARN number 10533. So while investing in any mutual funds, you can do mention this number. With my easy links are available, and even on my all my social site, Facebook pages, Twitter, Instagram, NFO forms are available. You can download the form, just fill the complete details, attach an account page check in the name of the fund with an PAN card, Xerox copies undersigned by the applicants. Only requirement is applicant should be an KYC compliant of the mutual fund. If you are not KYC compliant, do reach out to me or email me at my VIBES address, VIBES41 at the rate of gmail.com. Or if you have any queries, do message me or contact me. Even my personalized services are available, plus 24 hours online services preset, predetermined, and we can do it through online easy link. Links are available, you can do it by yourself, and even if you need a personalized survey, we can do it on your behalf, or even we can fill the form and just print, sign, and attach the documents or check and submit it at your place. Forms can be submitted anywhere in India at any of the Bandhan AMCs, Bandhan Mutual Fund offices or camps. We provide, Mr. D provide the host of services, offline, online services, and one-stop solutions for insurance and investments. When it's an insurance and investment, do think about Mr. D. Thanks